All right. So again, guys, thank you so much for joining us. We are excited to have you all to talk about how to get the best interest rates in today's market. We know that the interest rates are much higher than they were in the last previous years. So it means a lot that you all are taking the time to join us just to figure out what your options are and see what may be in the future for you in home ownership. So just to get started, I will turn it over to Kim. And let's see, Kim, you good there?
Oh, all right.
Yeah.
I'll come up. Did I do something? All right, so good morning, everyone. My name's Kim Miner. I'm a senior loan officer with Homeside Financial. Just to give you a little background on myself, I've been in the business for 24 years or so. Worked in a variety of positions over the years. And these past 3 years have been unlike my previous 24 years in the business. COVID really turned our industry upside down. As you all know, a few years ago, rates were at historic lows. And, that obviously uh, increased the volume of folks that were interested in purchasing and refinancing. So since then, rates have gone up, twice as much as they were just a few years ago. So I was closing loans in the mid twos, low threes. Now the rates are, in the sevens. So I know that's a significant increase from where we were. And, a lot of folks for a variety of reasons could not get in the market at the time. They just weren't ready. But I do want to share something with you that was just recently released by the National Association of Realtors. So they did a study which showed that homeowners' wealth is 40 times higher than a renter. So, I mean, that's a crazy number, right? 40% higher. So it's really, really important for your financial, well-being to become a homeowner, if you can and when you can. And hopefully you'll encourage your friends, families, co-workers to, become homeowners as well. So this was, an in-depth study. I won't go into great detail about it, but I do want to just show a couple of key indicators that they found. So based on income level, it shows over a 5, 7, and 10-year period based on your income, how much you gained. So if you were in the middle class, in 5 years, 84,300, 10 years, 122,000. It's just, incredible that all you need to do is become a homeowner and then increase your net worth $122,000 in 10 years. So, I mean, we're all putting some money into a 401k and perhaps your company is matching it, but there's nothing like just having home appreciation. So next study, this is, based on, racial ethnic groups. And one of the reasons why, I'm, really passionate about the business and, particularly working with first-time home buyers is because of these numbers and some of these, the disparity. So, if we just look at, Blacks, for example, their wealth is, significantly lower than Asians. So in a 5-year period, you know, Asians' net worth will have grown $141,190, whereas blacks is, you know, 90,000. So although there's a gap, there's still wealth building there. So there's good here, and there's, you know, just some work for us to do. So that's why we're here. That's why we're taking our Saturday to share this information with you. So hopefully this can be, you know, inspirational for you. This just talks about some of the areas throughout the country that had the biggest gains. You know, most of these are in California. Well, home prices are pretty high in California. My son lives in San Diego, and you know, if you buy out there and you keep your home, you're going to see a significant increase in wealth. So I just wanted to share that with you to help encourage you to, you know, stick with this. This is the first step. You know, I'm not sure how far you are in the process of becoming a homeowner, if you're just exploring, or if you are, you know, pre-approved or looking to get pre-approved. But I wanted to share this just, you know, to help you see the real benefit, not only of having a place that you can call your own, and there are many other benefits, obviously. You know, kids do better when they're raised in a home that's owned by their parents. The community does better. You know, there are a whole host of reasons. But, you know, financial is always a big incentive. So I can share this study with you, and Brittany can share this with you. She has access to it. So just email her and she can get this over to you so you can read the full report. So let's get into the current market. But before we do that, I want to just kind of step back before we actually talk about what you can do to help increase your odds of getting, you know, a great rate. There are many aspects of the home buying process. Rate obviously is a huge part of that, but let's just step back and kind of look at what this is all about, what rates are all about, and who creates the market. So there is something called a government-sponsored enterprise, which is a GSE. Now, this GSE was created by Congress to facilitate a market for mortgage interest rates. So if you think about it like this, everybody has a bank account, you deposit your payroll check in the bank takes that money, and they turn around and they lend that money out. So prior to GSEs being created, a bank would take in your money, they would lend it out. Let's say they lend it to someone to purchase a home. They do that for 30 years. That money is tied up for 30 years. Well, they have to have a lot of people depositing money so that they can continue to lend more money. So you can see at a certain point, it becomes really difficult, or would become really difficult for a bank to continue to lend. So the government-sponsored enterprise is an entity that Congress created to increase the flow of credit in certain areas of the U.S. economy, particularly real estate. But not only that, they also have other GSEs. So for real estate, it's Fannie Mae and Freddie Mac and Federal Home Loan Bank. Federal Home Loan Bank is a regional banks throughout the country. But in addition to that, government also created Sallie Mae. So many of us, you know, have student loans that are guaranteed from Sallie Mae. He also created the farm credit system for farmers. So this is a really important aspect of the of the mortgage market, and they're not actual government entities, actually kind of a quasi-government entity. So we've heard of Freddie Mac and Fannie Mae, but you know, this kind of helps you to understand what they are and their role. So Freddie Mac, Fannie Mae, and Ginnie Mae, we're probably more familiar with Freddie Mac and Fannie Mae, and I won't read this to you, and I can send this out to each of you if you send an email. But we don't really hear a whole lot about Ginnie Mae. We all know about FHA. So Ginnie Mae is the GSE that helps facilitate the market for FHA loans and USDA loans and VA loans. So how does all of this work? What does all that mean? So it's great that the government created these GSEs, Fannie Mae, Freddie Mac, Ginnie Mae, but what does that mean to you, and how does it really work? So you apply for a loan from a bank, and in this illustration, it leaves out one part, and I'll kind of circle back to that. So you go to the bank, you take out a loan, another person goes to the bank, they take out a loan. So the bank is generating loans. I'm generating loans. I'm creating loans. My company is creating loans. So once we create that loan and we go to closing, we fund that loan, what do we do with that loan? So we take those loans every month and we sell those loans to Fannie Mae and Freddie Mac. Okay, so they buy those loans, and then they turn around and they take those loans and they bundle those loans up, and then they sell those loans as a securitized instrument. Now, one part of this that's left out is when we fund a loan, when we create a loan, now banks get deposits, right? But my company is not a bank, so we don't get deposits. So where do we get our money? So we get our money from a warehouse line of credit. So we'll get a line of credit, just like if you own a home and you got a line of credit on your home or like a credit card. We borrow money on a warehouse line, and then we lend it to you. And then again, we sell it to Fannie Mae, Freddie Mac, Ginnie Mae. They bundle it up and they sell it on the securitized market. Does that make sense, everyone? Give me a verbal so I know that you guys are out there and you're not falling asleep on me.
Yes, it makes sense.
Yes.
Yes.
All right, perfect. Does this make any questions?
No.
Okay. So now that we know what Fannie Mae and Freddie Mac and Ginnie Mae do, how do they make sure that it's a level playing field, that somebody in California or someone in Chicago or New York and DC that are applying for a mortgage are all treated fairly, right? They're all evaluated equally so that there's no discrimination. So what they do is they come up with guidelines. Right? So these guidelines are rules that banks have to follow, my company has to follow, whether or not we're in DC, California, Chicago, New York. So they come up with these guidelines. We all have to follow these guidelines. And one of the things that oftentimes I'll hear clients say to me is, we'll ask them for some documents. So for example, when you apply for a loan, we're going to need to verify that you can afford the loan. So we're going to get your pay stubs, and we're going to need some bank statements to make sure that you have the money to pay for the down payment and so forth. So oftentimes clients will say, I'll ask for some documents. They'll send something, but it may not necessarily meet the guidelines by Fannie Mae or Freddie Mac. So I'll make a request, they'll send something. My processor, the person that works with me, one of my partners, right, to help facilitate your loan, will reach back out to the borrower and say, hey, thank you for sending what you sent, but we need something else. And I'll give you an example. So really simple, bank statements. Please send me your last 2 months' bank statements. Client will send over the bank statements. There's 5 pages, but they only send 4. The 5th page is blank. So they don't send it to me because they think It's a blank page. There's nothing on it, so you don't need it. Well, we don't know that that fifth page is blank. So then we'll reach back out and we'll ask them. So after a few times, people can become a little frustrated because we're asking them for things, but they don't necessarily understand why. We'll explain it to them, but people are living busy lives, and so it's important to understand that when we ask for documents, it's not because we're trying to make your life difficult. It's because we need to meet these guidelines by Freddie Mac and Fannie Mae. So what happens if we don't meet these guidelines? Let's say, for example, that our 5 pages, we only collect 4. So after closing, your loan will go to a post-closing department. People will scrub that file. They'll notice that there's a 5th page missing. So we'll reach back out to you for that 5th page. Now, if we miss it and we sell that loan to Fannie Mae or Freddie Mac, and they determine that that 5th page is missing, then they may kick that loan back to us. So we don't want that. Now, let me back up a little bit. So you see number 2, where the loans are bought by Fannie Mae and Freddie Mac. Well, if there is something, now a bank statement is easy, but if in the guidelines we miss something for some reason and it doesn't meet the guidelines, then Fannie Mae, Freddie Mac will make us buy back that loan. And oh, by the way, when we sell that loan to Fannie Mae, Freddie Mac, they pay a commission. So there's a spread there, right? And they pay us a commission because we originated that loan. We did all the hard work up front. They didn't have to. So they pay us a commission, and then when they sell it on the securitized market, they get paid a commission. So it's really important throughout that process that we meet the Fannie Mae guidelines. We dot our I's, we cross our T's, because when we buy back that loan, then we'll have to hold that loan, or we'll have to sell it on another market where people buy loans that don't necessarily meet the Fannie Mae, Freddie Mac guidelines, and we don't get that commission that we were expecting. So that's some background. Now, your rate. What determines your rate? So Fannie Mae, Freddie Mac, they want to make sure everyone is treated equally. So they're in a risk-based business, right? So they come up with these rules. Part of these rules are called loan level pricing adjustments. So a loan level price adjustment is a risk-based fee assessed to mortgage borrowers for conventional mortgages. And it's based on different traits. So there are, 30 different traits that we look at, that Fannie Mae, Freddie Mac, Ginnie Mae look at when we're evaluating your loan and doing a risk-based assessment of your loan. So we're looking at things like loan amount, loan term. We're looking at the purpose. Are you buying the house? If you own a home, are you pulling cash out, do some home improvements, or are you doing a refinance to lower interest rate? Is it a single family home? Is it a multi-unit home? What's your income to debt ratio? So there are many different factors that come into play when we're evaluating and determining what your interest rate is, in addition to these guidelines that Fannie Mae and Freddie Mac come up with. So now these loan level adjustments just recently changed. And there was a significant change effective May 1. So you're attending this meeting is really, apropos, because there are some loan level adjustments that are significant. So Any questions so far? Is all of this making sense?
Yes.
Yes, it is.
Yes, it's making sense.
Okay. Okay. So now we have a foundation. Let's look at what you can really do personally to get your best rate. And when we talk about best rate, we're also talking about more than just the best rate, right? That plays a big role in obviously you purchasing a home, but in addition to that, all these other factors need to be taken into consideration, right? So keep that in mind. So let's just look at, a scenario that might be appropriate in Prince George's County. I don't know where you all are located. If you're in Maryland, DC, Virginia. By the way, I'm licensed in DC, Maryland, Virginia, North Carolina, Georgia, Delaware, and Texas. So if you have any family that need to buy or refinance in those states, please feel free to refer them to me. But this example is for, a typical home here in Maryland. So purchase price of $400,000, borrower puts down 3%. And this presentation is really geared towards you getting the best rate. It's not really geared necessarily towards the whole process, home buying process, but it's a relatively small group. So if you have questions about that, feel free to ask. One big thing is, and this focus strictly on conventional loans. With a conventional loan, if you're a first-time home buyer, you can put down as little as 3%. There was another recent, how are you? All right. There was another recent study that was conducted, and I was really surprised by the results. So since we have a small group, and because you guys haven't said anything, I want to take a quick poll. Did you all know that you could put down as little as 3%? Because the study showed that like 60% of millennials thought that they had to put down 20%. So were you guys aware that you could put down as little as 3%? You said yes, no.
Yes.
Yes.
No.
Okay.
Yes.
Okay. So I know, a lot of our parents or grandparents, when they bought a home back before there was a GSE, they had to put down 20%. As a matter of fact, a lot of those loans had a balloon payments at the end. So the bank would lend the money for parents or grandparents or great grandparents to buy a house. Back then, the homes were $20,000, $30,000. Those loans came due after 5 years, and then they'd have to pay that loan off, or they'd have to refinance. That would allow the bank to recapture their money, and if the market had shifted, right, and rates had gone up, then the bank could relend that money at a higher rate or a lower rate. So, it's really, huge that all you have to put down is 3%, and much of that, all of that really has to do with the fact that there's something called mortgage insurance. So again, I'd like you guys to participate. Has everyone heard of mortgage insurance?
Yes.
Everybody else?
Yes.
Okay. So you can put down as little as 3% because mortgage insurance protects us as the lender against default. So instead of putting down 20%, if you put down 20%, then you do not have to have mortgage insurance, right? If you put down 20%, you don't have to have mortgage insurance. So as a lender, we want to protect ourselves against default. We're lending in this case, $388,000. If a borrower defaults on that loan, the mortgage insurance is going to pay us for the amount that you defaulted on.
So Kim, what determines the amount of the mortgage insurance?
So that's a great question. So, credit score, your initial loan to value, and your income to debt ratio, and where the property is located, type of property. So these mortgage insurance companies, right, they're risk-based. They've got millions and millions of examples, so we know what the likelihood of somebody defaulting on a loan is. And based on all of these different criteria, they come up with a factor that they charge that you have to pay to protect us. But it's a relatively small fee so that you can get into a home with as little as 3% down. So I think it's well worth it. A lot of people poo-poo it, they want to get rid of it, but without it, it'd be really difficult coming up with 20%, right? In this market. So not only do you have to come up with the down payment, but you also have to pay what? Closing costs. So, in this market, it's hard enough to come up with the 20%, then you have to come up with the down payment. And buying a home would be really, really difficult. So mortgage insurance is necessary, right, for many of us. So in this particular example, buyer's putting down 3%. It's a purchase, 30-year single-family home versus a duplex or a four-family. It's conventional. It's the primary residence, so it's not an investment property. Their DTI, which is debt to income ratio, is 38%. It could be 45%. I put that there and I'll show you why in a few minutes. Credit score is 680. They're locking the loan for 30 days. They live in Maryland and they're buying in Prince George's County. So is that pretty typical
Yeah.
purchase price? So this next graph shows what the conforming loan limit is in Maryland. Has anyone heard of conforming loan limits? Yes, no?
No.
Okay.
No.
Thank you for that. Thank you for that. Thank you for that. So conforming loan limit is really important. Why is it important? It's important because depending on where you live in Maryland, in California, in Illinois, in New York, we all know that there's different economic levels. So we live in, the DMV area. It's a more affluent area. Incomes are greater, home values are greater than they are in, say, Baltimore. So what happens is Fannie Mae, Freddie Mac, Ginnie Mae, they all come up, they have a committee and they come up with a baseline loan amount that, again, they want to keep the market fair for everyone. So they say, this is a loan amount that is fair for this area. If you buy outside or above this conforming loan limit, then what happened is we gave you money to buy a home that would increase the risk to us. So let's just take an example. So, or let's look at all of these. So in Anne Arundel, for a 1-unit single family, the conforming loan limit is $726,200. Whereas in Charles County, it's $1,089,300. In Howard County, it's $726,200. In Prince George's County, it's $1,089,300. So why is that important? Well, that's important is if you buy a house in Anne Arundel and you pay over $726,200, so let's say you buy a $800,000 house and you default on that home, then it's going to be really hard for the bank to resell that $800,000 house that now may be worth $850,000 because there's fewer people buying an $850,000 house. there's more people that will buy a 726,200 home or less. So there's a greater pool, they can sell that house quicker. And so that's why they come up with these loan limits. So this is an important factor for you to consider, for you to keep in mind. When you're buying a home, it comes up, very often, particularly in Howard County, right? Because it's close to Prince George's County and Montgomery County, but it's really in the Baltimore market. So keep that in mind, and I'll show you why that plays a role. So we're getting to the meat and potatoes here, folks. So remember I talked about the loan level pricing adjustments? Well, this is the matrix. These are the rules that Fannie Mae, Freddie Mac comes up with to keep the field level. So just highlight it as an example. This is based strictly on credit score and your loan to value. So your loan to value is going to be your purchase price divided by let's go back. It's going to be your loan amount divided by your purchase price. So Fannie Mae says if you have a credit score between 680 and 699 and you put down less than 5%, your risk level adjustment is going to be 1.125. Versus if you have a credit score of 780 and you put down 5%, the risk assessment is 1% less. So what does that tell us?
The higher the credit score, the better.
I was about to say.
You got it. Thank you very much. Thank you very much. Who said that? Who said that?
Rennie.
What's your name?
Rennie Grant.
Thank you very much for that. So the higher the score, right, the less risk Fannie Mae assumes that the higher your credit score is, the less risky you are. So that's one adjustment. Here are some other key factors that they use to determine your interest rate. So I'm really going through this, folks, so that you can see that there's a lot of factors that go into this. And so you can't really just call me and say, hey, Kim, what is interest rate today? Right? I need a lot more information. There's 30 different factors, plus what these loan level adjustments are that Fannie Mae and Freddie Mac and Ginnie Mae have, similar adjustments. So one change that's taken effect now is they're looking at DTIs, income to debt ratios, over 40%. So if you have a debt ratio over 40% and you're putting down 5%, then they're going to hit you with 0.375 to your rate. So all of these things are going to ultimately determine what your interest rate is going to be. But there are other things like, are you buying a second home? Is this an investment property? Oh, guess what? If it's a condo, they're going to hit you with 75 basis points. A lot of people didn't know that. I know there aren't many manufactured homes in this area, but there are in like the Midwest and the South. We say that all the time when there are tornadoes coming through and they wipe out, homeowners. What are other factors that they look at? Is an adjustable rate mortgage? But the other big factor is it a high balance loan? So the good news is for first-time home buyers, they are going to waive if you meet certain qualifiers. Now, Fannie Mae has a program called Home Ready. And if you meet the qualifiers for our Home Ready program, then they're not going to assess these loan level adjustments. And we can get into that Home Ready. Freddie Mac has something equivalent, which is called a Home Possible. But those are all going to be based on the area median income of the area where you're buying a home. And I can, if we have time, I can log in and I can show you more about that. But that's the good news. Actually, I did include it. Okay, so we can see if your income in Baltimore is $92,880 or less, you would qualify for this Home Ready program. And by the way, not only do they not hit you with the loan level pricing adjustments, but they also offer a better interest rate and a lower mortgage insurance factor. And Upper Marlboro, for example, in all of Prince George's County, if you make $112,400 or less, then you qualify for the Home Ready. In Charles County, the same. So what do I do as a loan officer? So part of my role is to keep in mind all these different moving parts, all these 30 different factors. Do you qualify for the Home Ready program? Do you in fact qualify for the Home Possible program? But also what's going on in the market, right? So question, how often do mortgage interest rates change? Brittany?
I would say
Not this Brittany, the other Brittany. Daily, weekly, monthly, sometimes within a day. What would you say? Maybe she's not there. Anybody else? How often do mortgage interest rates change?
I was about to say maybe quarterly.
Quarterly?
Yeah.
Okay. Anyone else? Daily, weekly, monthly, quarterly, yearly. So if you wanted to buy a house today versus a year ago or a month from now, I'm just curious. This helps me to understand what you all are thinking about rates. So daily, weekly, monthly, how often would you say?
Perhaps monthly.
Okay. Sydney? Come on, folks. It's easy. Weekly, daily, monthly?
I mean, like I said, probably, like somebody else just said yearly too. It could vary. I don't know. I still gonna stick with quarterly.
All right. So rates are going to change daily. They could change in the middle of the day. So rates can come out in the morning, and then we could have something like 9/11 happen, and then that will affect what the mortgage interest rates will be. So rates are really affected by many different factors in the economy. So if you're watching the news and you hear about we all are hearing about inflation, right? So that's a big number and that's it's just a statement. What does that really mean? So unemployment, if the inflation number is coming down, is that going to have a positive impact on interest rates? If the Feds, we all hear about the Feds are increasing rates, right? What does that mean? So the Fed increasing rates don't directly affect mortgage interest rates, but they do indirectly. I won't get into all the nitty gritty of that, but the fact of the matter is interest rates change daily. So again, many people talk to their friends, bought a home a month ago or 2 months ago or 6 months ago, and they got one rate, and you can't really compare what your friends or your family, the rate that they got based on what you got, because rates do change every day. And you don't know what those 30 different factors, what their factors are. So part of what my job is to monitor the market. So I have different tools that I use to monitor the market so that I can help advise you on, okay, you're under contract, you have a ratified contract, but should you lock your rate the day that you get ratified? Or is there some economic news that's coming out that may cause rates to go down so that you can get a better rate? So you want to make sure that you're working with someone who is monitoring the market. This is just one tool that I utilize. This is mortgage interest rates on a daily basis. They go up, they go down. This is called a chart and candlesticks. I won't get into what all that means, but the fact is that that is part of what my job is, and that is what I do. So this is why you guys are here. This is what you want to know. This is what you can do to increase, to get the best interest rate. And again, this is not an anti-FHA presentation. I do a ton of FHA loans. Every scenario is different. So this is not to say that FHA loans aren't good. We can get into all of that at a different point in time, but this is what each of you can do right now to get the best terms. So we looked at conforming interest rates. There's a loan amount that we come up with. When you go over that, doesn't mean that the bank won't give you a loan over that conforming loan limit. It just means that they're going to charge you a higher rate. Okay? Work to get your middle score above the 780. So let's talk about credit scores real quick. So we use the middle credit score. We don't use an average, we use the middle. So if your score is a 700, a 710, and a 720, we're going to use a 710. We're going to use that middle score. That's what all lenders do. It's not just what I do. It's what Fannie Mae, Freddie Mac, that's what they tell us. That's what they want. Okay? He who has the gold makes the rules. So pay down your debt so that your income to debt ratio is below 40%. I know that's hard to do, but that's a plan. That's something to work towards. Start the process early. The earlier, the better, because there are so many different factors that may come into play, right? That may take you a while to address. So we've been in this business a long time. We've all had issues where people are, they got all psyched up. They're ready to go. They fill out the application. And I said, well, we need to work on this. Maybe your credit score is a little bit low, so we need to do something to get that up, to get you qualified. That may take a month or two. So start early. I just say at least 3 months. The earlier, the better. Now, purchase a primary residence, single family primary residence, right? I have a lot of folks, particularly young folks, because there's a lot of programs on TV now about flipping homes. So my recommendation is always, if you've never owned a home, you don't know what owning a home is all about. Your parents may own a home, but I always recommend buy a primary home first to get started before you buy an investment property. Now, I know there's all sorts of, people on the internet that say don't do that, but again, what I recommend, you buy a primary home, stay in it. You can then rent out that home. Then you know what's involved in owning a home, the repairs, right? The upkeep. But stay in it. If you want to do an investment property, you're going to get better terms if it's a primary residence versus an investment property. So you buy primary, stay in it. You can rent that and then buy another one, a move up, for example. What else? Choose a conventional loan. Why conventional? Well, because with FHA, there are some additional fees that are associated with an FHA loan. They're not bad, they're just different. Again, I love a FHA, but if you can get in a conventional loan, I recommend you getting best terms going conventional. Take advantage of the Home Ready, the Home Possible affordable product. Okay, and that's if you meet the income requirements. We saw what they were. If you don't, then you can't. Now, one quick thing is if it's a husband and wife and the husband makes less than the Home Ready limit, he can qualify for a home and leave his wife off, because if he had her income, that would go over. That's another strategy. So choose a loan officer that monitors the market. Ask lots of questions. You got a question? Okay.
Someone did ask a question though in the chat. So Sydney said when you say middle credit score, you are referring to the Equifax score?
Great question. So when we pull credit, we'll pull a tri-merge. So we're going to pull Equifax, Experian, and TransUnion. So we're going to pull all three, and whichever one is in the middle is the one that we're going to go with. So it doesn't matter if it's Equifax or TransUnion or Experian, it doesn't matter. We're going to use the middle score. So these factors are going to help you. Now, some of you may or may not be familiar with the Maryland Mortgage Program. It's a great program because it can help you with your down payment. We talked about that earlier. And not only that, but the Maryland Mortgage Program also has they have a lot of programs, but one of the programs that I really like is the First Time Advantage Direct. It's that very first one at the top. And the reason why I like that is because it's got a great rate, right? It comes with no points, no discount points. And we didn't really get into discount points, but it just means it's less money out of your pocket. Another reason why I like this is because if you go through their program, then they offer a discount on that mortgage insurance. So that's another big factor. But some of the other reasons, since I have this up, to consider the Maryland Mortgage Program is if you don't have the money saved for your down payment, then they can help you with as much as 6% of the purchase price if you qualify for that. And again, this has an income qualifier for the Home Start. They actually all have qualifiers for their program, but the Home Start's a little more restrictive. But you could get a 5% loan that would take care of your down payment if you're putting down 3% on a conventional, and then have some money left over for your closing costs. In this market today, I think it's a phenomenal time to buy. Even though interest rates are higher, it's really an excellent time to buy, and I will tell you why. So we all know a few years ago when those rates were in the 3s, we all have friends or family members that had to put in multiple offers on a home, and they oftentimes didn't win out on that offer. So they have to look at 8 or 10 or 12 different properties, put in offers on all those before they may have ultimately got a home that was ratified, that the seller agreed. Many people weren't able to buy a home at all because the market was so competitive because the rates were so low. Well, now it's the reverse. There's not as many people who are looking. Why? Because interest rates are higher. So they're sitting on that sidelines and they're waiting. What are they waiting for? They're waiting for rates to go down. Okay, so we got a backup of people who should have bought, let's say a year ago, that are sitting here and they're waiting to buy a home because they're waiting for the market to come, the rates to come down. No one can time the market, right? No one. So what has happened is sellers are more apt to help buyers pay their closing costs. Would you agree?
Yes.
Okay, there's less competition out there. So you're going to pay a little bit higher in interest rate now, but you're going to get perhaps the seller to help you with your closing costs, right? You're gonna find the home that you want. You're not gonna buy a home that you just making an offer on because, you know, like 2 years ago, you're just making offers on anything just to buy a house. So I'm here to tell you that rates are a little bit higher, but it's excellent time to buy because rates will come down. So when they come down, you can do what?
You can refinance.
You can refinance. You can refinance into a lower interest rate, but you'll be into a home that you want. If your agents are able to negotiate with the seller to get that closing cost down, you're going to get, have to come up with less money as well. So that is my presentation.
Well, thank you so much, Kim. I'm not going to hold you all too long, but okay. Just to kind of give you a recap, because I know some people didn't start at the beginning of the presentation. But just to give you all a quick recap, I think the first thing that you should take away from this info session is that this was a lot of information to take in as the buyer. So you want to make sure that you are reaching out to a lender that you trust, someone that is considering all of these factors, someone who is up on what's going on in the market, in your current market. I know a lot of times I may get some buyers that they saw an advertisement for, I'm not going to throw any names out there, but I will throw names out there. So maybe you see like Rocket Mortgage, or you see an online bank that is offering you something. But when you get a lender with those companies, you're not necessarily getting a lender who is knowledgeable about your market, someone that lives in this area, or anything of that nature. They may be doing your loan in Maryland, Virginia, DC, and then they may also have 20 other loans in California, Georgia, and all different places, and they're not really an expert in your market. So I think
they're not an approved lender. You have to be an approved lender for the Maryland Mortgage Program.
Got it. Yep. So they're not, as Kim said, they may not be an approved lender for the Maryland Mortgage Program or any other program that is specific to your area. So it is very important that you get in touch with a lender and a realtor that services your area. You know, we are all Maryland, DC, Virginia realtors, and Kim, a lender, and we're very knowledgeable about the area. So that's one thing that's very important. Another thing that you want to make sure that you're doing is just asking questions. No question is a dumb question. I know it is very hard to ask questions in this open forum with a lot of different people when it may be your personal situation that you want to have questions about. So I will make sure that you get all of our contact information so that if you do have any questions outside of this webinar, you'll have the opportunity to ask those questions. It was something else that I wanted to say to you all that I do not remember now. But again, thank you guys so much for joining us. Just to kind of wrap it up for you all, this is one of the first parts of the homebound process. So you want to make sure that you are educating yourself and that you're knowing what your options are before you jump out there and start viewing properties. Once you get this type of knowledge, you kind of have a better understanding when you do get out there to view properties, to see what you actually qualify for and what your options are as far as home ownership. A lot of times people will go as a first-time home buyer and want to purchase their dream home. A lot of times that does not happen. A lot of times your first home may need to be a starter home, especially if the interest rates are a little bit higher and the home prices are a little bit higher than you would hope for. Maybe your first home is a starter home where you can start to build up some equity and use that money once you're ready to move out of the home. Once you sell it, you'll have a little bit more money that you can pull out with that equity to go and buy your actual dream home. So that's your forever home. And then also, if you do have children and things of that nature, it may not be the best thing to buy your forever home while your children are still young, because at some point they may move out and do different things, or your life might change. So those are a few things that I want to share with you all. We will be in touch with, just some different updates, or just a high level overview of what we went over today, because I know that some people came in at different points. Does anybody have any questions for us before I let you all go? I'm gonna look in the chat. Yes, so Sydney, I'll make sure that you get Kim's contact information. Thank you so much for joining. Tamala, thank you. She said, thank you, nice presentation, so thank you so much. Yes, so I'll make sure that everybody gets the contact information. And the last thing that I'm gonna say before I let you all go, it is very important. So even if you know for sure that maybe you're not ready to purchase into next year, it's very important to start with doing a lender application just to see where you fall right now. So maybe you have to work on some things until you're able to purchase next year. If you start now by doing that lender application, which is free, you'll be able to determine like, hey, these are some factors that I need to work on right now to be able to get the best interest rate for myself. In a nutshell, in order to get the best interest rate, you should reach out to a lender. You should reach out to a realtor and ask those questions. Make sure that you're doing your loan application so that we can advise you on the things that you could be working on to get a better rate. Maybe you'll apply today and your rate may be 8%. But we can work on some things in the next 6 months to a year to get you at the best possible interest rate that there is. A lot of times people will say, okay, well, I need to work on my credit. But what does that really mean? It's some things that, people will say, I need to work on my credit, but that may mean I'm going to go pay off everything. That's not necessarily the case. So before you start paying off anything, do that lender application, which I'll make sure you all receive in an email. And once you do that lender application, Kim will be able to let you know you do not need to pay off your medical bills, but you need to do X, Y, and Z to improve that score. So those are some things that we can help you with. Thank you guys again so much. I'm really going to let you go this time. Any questions that you all have, feel free to reply to the email that I send out, or give me and Kim a call, or if a specific agent invited you, please reach out to them and let them know what questions or concerns you may have, and enjoy the rest of your Saturday.
Thank you, everyone.
All right,
Bye,
thank
guys.
you. All right, you guys
All
have a
right.
good one.
Thank you.
Bye.